welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. Today I'm interviewing Frank Hanna. Frank is a chartered financial consultant, private wealth advisor, and is a leading specialist in estate planning, business succession planning, and wealth management for a select group of individuals, executives, and privately held business owners. Frank spent 15 plus years within the restaurant hospitality industry, operating several of his family's restaurants and bars in Delaware and Maryland. In 2007, he launched a financial consulting firm within his family business, providing guidance in real estate development, tax management, and private investment. In today's episode, we'll dive into an alternative to a 1031 exchange. Hey, Frank, welcome to our podcast.
Thanks, Sari. Very excited to be here.
Yeah, I know before we started recording, we were talking about something really interesting, a tax planning real estate strategy. I want to learn more about that. But before we get into that, I want to know more about your background.
So I've got a business background for years. I was in like the restaurant, hospitality, nightclub business. It was a family business, did that for years and learned a lot of good stuff, but ultimately didn't have a true passion for it. Had a little bit of a background in real estate and, some tax planning and, kind of identified a void, I'd say, in our particular market, kind of in the tri-state area of Maryland, Delaware, Pennsylvania, where there was lack of, I'd say competent, independent, objective financial advice. So we basically went out and kind of created a boutique hybrid program where we are traditional financial advisors by trade, but we also have a syndicated real estate arm where we help people with not only traditional financial planning needs similar to what you do, but also kind of high level tax planning and real estate advice and investment, whether that's how to get started or hey, I've got a pretty significant real estate portfolio and I'm thinking about diversifying or divesting of some of those properties. What's the best or most tax efficient way in which I can do that?
And that's pretty creative because usually when it comes to traditional financial advisors, usually it's stocks, bonds, mutual funds, right? It's usually
Yep.
doesn't involve real estate. So I think it's really important that you are involved in real estate because there's a lot of, a lot of people, first of all, a lot of people own real estate. Second, there's a lot of, capital gains, a lot of things that happen tax-wise with real estate. And we were talking, so there's a common part of real estate, right? 1031 exchange. This is where you buy property, you sell it in the future for a gain. Instead of paying long-term capital gains on that, you do a 1031 exchange, you roll it into another property and you simply defer. You don't eliminate the tax liability, you just defer it for a later date. And there's pros and cons to that, right? You don't have to pay the benefits, you don't have to pay taxes, but the downside
Yep.
is you're just deferring it for even a greater tax bill later on. But there's
Yep.
something else we could do, right? Some sort of trust. Do you mind describing that trust and the alternative?
Sure. So I think this statistic is there's 10,000 baby boomers or people turning 65 every single day in the United States.
Mm-hmm.
This is, I'd say a primary demographic, but there's people much younger and much older that are looking at this as a, attractive planning tool. So yeah, the 1031 exchange has been around for 100 years and it was specifically designed for people to have incentive to reinvest their dollars into real estate to continue moving the economy in a proactive direction. The 1031 exchange also has an alternative that's more of a passive solution that has been around for several decades, and it's called a Delaware Statutory Trust. And essentially, it's a prepackaged, professionally managed portfolio of institutional grade real estate that allows you to sell your hard piece of real estate and do a complete tax deferred exchange and get a proportionate ownership or shares in a real estate program in a variety of different asset classes. It works exactly like a traditional 1031 exchange,
Mm-hmm.
but instead of reinvesting in a hard piece of real estate, you can reinvest in a passive solution like this that provides a monthly tax favored income. And you typically give up all the management responsibilities of the program. They typically last anywhere from, I'd say, 4 or 5 or 6 years.
Hmm.
And at the end of these deals, ours in particular almost always sell for some degree of profit, and you have the same choices you had going into the deal that you do coming out. You could cash out, pay the tax, you could reinvest in another Delaware statutory trust with us, or you can actually reinvest and go back into traditional or hard real estate. The running joke that most people that have a certain degree of wealth and liquidity is you can defer and then die. And what the joke about the die is under current tax law is if you die while
Hmm.
you still own the asset, your children or your heirs get a step up in basis so they can inherit the real estate after death, and
Hmm.
that new value or the new tax basis is a date of death value.
Hmm.
So you can almost eliminate all of the tax liability. So as you touched on a few minutes ago, eventually, if you don't pass away with the asset and you decide to sell or cash out at some point, you do have to realize the tax. But most of your, more wealthy or affluent real estate investors, that's their game plan, is to hold forever or continue to do exchange after exchange and pass away with the asset and swap till you drop or defer
Hmm.
and die, whatever you want to call it. And the kids can get a step up a basis. And you can do that with your stock portfolio, really anything out there that might have a low basis. It's not strictly you know directed towards real estate.
Hmm. The trust, the assets in the trust, is it like a trust, and inside the trust there are limited partnerships of real estate deals
Yep.
inside of the trust?
So each trust is its own entity created under Delaware statutory law. Other than Delaware being a favorable state for legislation, it has nothing to do with Delaware. So some people say, "Oh, well, do I have to own real estate in Delaware? Do I have
Yeah.
to reinvest in Delaware?" No, has nothing to do there. Each trust has its own asset or assets. So we do deals in multifamily, self storage, student housing, industrial, essential retail, senior living, whatever asset class might be of interest to you. We have attractive deals that are available there. Um, and sometimes it's one asset, sometimes it could be a dozen assets, but each trust is its own separate legal entity and it has a finite amount of capital. So it's not like an open end mutual fund or something that constantly takes in new
Yeah.
investors. They have a finite capital raise. Once they reach that ceiling, the trust is closed and your percentage ownership is based on how much money you put into the deal. Typically, most of the sponsor companies that we work with are heavily vetted, been in business for a long time, have super strong track record and financial scale. And I'd say right now they pay anywhere from 4 to 7% in income,
Mhm.
with some nice upside appreciation. So of all the things we do and offer to clients, this has probably been one of the more popular vehicles. We've
Mhm.
seen kind of a boom in real estate lately, over the last 5, 10 years. So people are looking to cash out per se with their heavily appreciated real estate.
Mhm.
But again, unless you need the dollars, most people don't have the appetite for the capital gains taxes, right?
Right. That makes sense. So a benefit of the Delaware Trust is not only are you deferring the taxes, but also you are creating some liquidity. The 4 to 7% return annually that can generate some income. And I believe not all of that income will be taxable, right? I think they'll probably use some sort of formula where the money that's coming out of the trust, a portion of that is gains and a portion of that is a return of basis.
Yep. Yeah, good point there. Sometimes, and you also, yeah, you get to participate in pass through depreciation. So a lot of our deals, even though you might be getting 4, 5, 6, 7%, might
Mhm.
feel more like 7, 8, 9, 10% because you're only paying taxes on a small portion of those deals.
Mhm.
These type of deals, although the tax savings from a 1031 exchange is really impactful for the investor that's on the hook for that capital gain. That's probably your primary candidate, but there are a lot of people that like investing in these type of deals with cash on the sidelines. just because, for one, it gives you a predictable tax favored income
Hmm.
stream, mailbox money, whatever you want to call it.
Yeah,
And it's a tangible asset. It's not like a mutual fund where you have shares of something you don't really understand what you own. You
yeah.
know exactly where this asset is. We have a lot of clients that go visit the asset. We always visit the assets and we invest in a lot of our deals, but people can go see, touch the asset they own interest in, and I think people like that.
Yeah, I think this is really smart because let's just say, for example, I buy a property. It's I sell it for $1 million, right? It's one property. I sell it for $1 million, and then I instead of paying taxes, I decide to apply the trust that you're recommending. It goes into trust.
Yep,
Now it doesn't have to be $1 million in one trust. It could be $1 million in 10
exactly.
different properties. It could be
Yeah.
multifamily, self-storage, all
Hmm.
types of real asset classes.
Yeah. So just like everything in our world, diversification is key, right? You don't
Yeah.
want all your eggs in one basket. So we often encourage that. So we do have deals where people bring us, whether it's a million or 10 million or
Yeah.
whatever amount,
Yeah.
we encourage true diversification. And yeah, again, most deals you can do as little as 100,000.
Yeah.
I've had people where they'll do a traditional 1031 exchange. They'll find a hard piece of real estate they really like, right? But the numbers don't match up perfectly, and they have some boot or exposure or
Yeah.
leftover that they can't reinvest. So they'll use us as like the backup, right? And
Hmm.
say, hey, you know what? I sold an asset for a million. I found a new one for 800. I don't really feel like paying taxes on the excess 200. I'll do a Delaware Statutory Trust with Frank and Revolution X.
Yeah, and you mentioned boot, and for those who don't know, boot is where it's not a like kind. So that means I say, "Hey Frank, I want to change my property for your property, and I'll give you another 20,000 on top." That
Yeah.
extra cash is not like real estate, so it'd be considered boot.
Yeah, yeah, yeah. So in a traditional 1031 exchange, that's a scenario of boot. Or again, the requirements of the 1031 exchange are you have to reinvest an equal or greater real estate value, and then you also have to replace your debt equal to or greater debt. So that's another thing that we're seeing a lot right now, right? So just a few years ago, if a lot of your listeners, I'm sure, can relate, had super low interest rates, right,
Hmm.
on a mortgage. And now, if you pay off your mortgage that was maybe 2 or 3% in a 1031 exchange, you're required to go get another mortgage from a bank. And now you might be paying 7 or 8%.
Oh
So
wow.
the financing costs go through the roof, right? So we have a lot of people that'll come to us for a Delaware Statutory Trust that might have much more favorable financing baked into the deal. So
Hmm.
we have a lot of debt free deals. We have a lot of other deals that have a predetermined amount of debt in the deal, but the financing terms are much more favorable than you or I could go find it at a bank right now.
Because it's not tied to banks, right? Is that why it's favorable?
It's just because of, I'd say, our relationships, the amount of business we do. Some of it's private lending, some of it's banks, but yeah, I'd just say based on the amount of business we do,
Yeah.
our relationships and our private investors, we can get just much more favorable terms. Interest only loans, I'd say our loans right now are 3, 4, 5%
Hmm.
versus 7, 8, 9 or more.
Have you been seeing a lot, like an uptick, an increase in sales of real estate, of people selling their actively managed properties to get into more on the passive side?
I have, I'd say 10 years ago, this was probably 10% of my business. Last year, it was probably like 60% of my business.
Oh wow.
So, when real estate goes up, and coming out of COVID, real estate skyrocketed, right? So we
Right.
saw the insane, acceleration in real estate values. So a lot of people want to, take advantage of that and potentially, cash out on those deals. But a lot of people are unaware of, what a 1031 exchange is, or the existence of passive real estate options, right?
Hmm.
So if you have real estate clients, a lot of people, are real estate sales. They go to, somebody that has a property and say, hey, I can sell your property for X. A lot of the pushback is, okay, that's great, but one, I don't want to pay the taxes. And if I don't want to pay the taxes, I have no idea where I want to go next. I don't necessarily want to go buy another property somewhere else that I've got to
Hmm.
manage and deal with that might not be as attractive as the property I'm in currently. So, what other options are out there? So, we proactively just want to educate clients that, hey, this is an alternative that you need to be aware of because you might encounter a situation down the road where you're going to be in a position to sell your property. And if you don't need the cash in hand and you want to elect to do a 1031 exchange, you can certainly do that, but know that this passive option is out there. A lot of our clients sell a piece of real estate, try this once with us, and then end up liquidating all their properties
Hmm.
because it suits their needs and they can get the financial freedom of
Hmm.
not having to manage all those properties.
Yeah, and a lot of people think that, and I see this too on the real estate side. A lot of people think that if it's passive, it's less returns than active, and it's not always true. Sometimes it can be
No.
the same. Yeah, sometimes it can be more. You can make more in a passive deal than you can actively if you consider your time and energy that you
Yeah,
put into the deal.
exactly. I tell a story all the time, and I have had a client that's had attractive real estate up and down the East Coast, and he said, Frank, I thought I was really doing good. I thought I was getting 6, 7%, 8% on my money, but then when I factored in my my property taxes, my insurances, my repairs and maintenance, my realtor fees, I was netting like 2.5%, and my life was hell because
Yeah.
all week, every week, I was getting phone calls for problems and different things going on. So he actually sold one piece of property and he's ended up selling, I think, 20 plus pieces of property and doing all Delaware Statutory Trusts with us.
Oh wow, that's awesome. So let's just say I reach out to you. Can you walk us through like the process? Like how long does it take? What do you need to know? Kind of
Yep.
your steps.
Yeah, so I would say, we're a good resource hub, even if you're just wanting information on 1031 exchange planning. So I get a lot of people that are either, hey, I'm considering selling my property, or I've got a property under contract that I'm going to sell. What's my next step? So the first step we need to follow is you need to hire a unaffiliated third party individual, which is called a qualified intermediary. And they are strictly in a position to make sure that you, as the seller, cannot touch or take possessions of the funds settlement table.
Hmm.
So you need to, we can hold your hand, walk you through that process, introduce a qualified intermediary, or QI as they
Yeah.
call them. And that's strictly what they do, is they're there to be the middleman in your transaction. They set up an insured escrow account. So at the settlement table, instead of those dollars going into your personal bank account,
Hmm.
they go into this escrow account where the day of settlement, there's a clock that starts ticking on a 1031 exchange. You have 45 days to identify one or several properties that you intend to potentially purchase.
Hmm.
And then the remainder of day 45, from a total of 180 days, you have to go ahead and buy or purchase those properties or DSTs. So a lot of people will say, hey, you know what? I'm doing a 1031 exchange. I really want to invest in real property, but I don't want to get caught with my quote unquote pants down if the
Yeah.
deal falls apart.
Yeah.
So what can I do to prevent that? You can contact us or somebody like us,
Hmm.
and we can walk through a menu of Delaware Statutory Trust programs that you can list on your identification sheet and utilize if your deal falls through or you need to cover that taxable boot that we talked about.
Hmm.
So we get a lot of people that contact us. We're not qualified intermediaries.
Hmm.
We're more consultants, and we can help on the Delaware Statutory Trust side of things. But a lot of people will contact us just for information and guidance, put them in touch with the right people, whether they need a QI recommendation
Hmm.
or a realtor, they're looking for a person in a particular asset class, or a property in a particular asset class. We can guide them to a lot of really good resources.
Hmm.
But yeah, that 1031 exchange timeline, it might sound like a long time, 45 days to identify, total of 180 days to execute that purchase. Believe it or not, it goes really quick. So it's important to be, plan ahead, have your options kind of laid out and know what avenues you might need to pursue if the game changes on you.
Yeah, definitely. In the real estate world, 45 days is like every single day looking for property on
Yep.
calls, visiting properties. It's really intense, 45 days in real
Yeah,
estate
it is. We
world.
we get calls on people's 44th day, and they have no, they're scrambling, and we got to help them figure out what they're going to do. And again, worst case, even if you're a control type of investor and you like the hard real estate, you know taxes are big and impactful, and oftentimes we'll use the Delaware Statutory Trust just to prevent against not being able to find that right piece of real estate that you want.
Mhm. Yeah, I think this is really important. Actually, I didn't know about this before this meeting, so thanks for mentioning this. I think it's going to
Sure.
be it's really good. It's going to be really important for a lot of people right now who are selling real estate.
Yep.
How can the listeners connect with you and learn more about you?
So our company's called Revolution X. We go by RevX sometimes, but our website is www.revxwealth.com.
Mhm.
You can go to our website. RevX Wealth is all over LinkedIn, Instagram, Facebook, X, or Twitter. And you can find us there to take in good contact. But if you go to our website, you can call us, email us. Happy to answer questions, no strings attached, and promise you'll get good value, even if we can't help you directly.
Yeah, awesome. I'll be sure to add in the links you mentioned in the show notes below, and I'm looking forward to having you back on the podcast.
Yeah, that's great, Terry.
Thanks.
Appreciate it. Thanks a
Thanks.
lot.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.